Dear students, we are starting with the mock test paper of October 2021 for CA final for the subject of strategic financial management of the new course. So let us start with the question paper. Once we complete the entire question paper, then we are going to have a review of the same in terms of the practical questions, theory questions, difficult questions, simple questions, moderate questions, and also the chapter wise bifurcation that we are going to see once we complete the entire paper. Let us start. Question number 1 is compulsory. Attempt any 4 questions from the remaining 5 questions. That is the usual paper style that we have. Working notes should form part of your answer. Okay. Many a times you may be provided with the information that say you are required to write answer in how many decimals. If at all such kind of clarification is made in the question, then make sure that you are writing answer as per that instruction. Question number 1A. Z has to remit $1 lakh for her daughter's education on 4th of April 2021. Accordingly, she has booked a forward contract with bank on 4th of January 2021 at the rate of 73.8775 rupees. The bank has covered its position in the market at the rate of 73.7575. The exchange rates for United States dollar in the interbank market rate on 4th, 7th and 14th April 2021, whereas under. We have been provided with information about the spot exchange rate, spot March, April, May and June. Exchange rates have been provided on 7th April, again the same, and for 14th April, again it has been provided to us. Exchange margin is 0.10% and interest on the outlay funds at the rate of 12% are applicable. The remitter, due to rescheduling of the semester, has requested on, this is the important date, 14th of April 2004, that is 21, for extension of the contract with the due date of 14th of June 2021. So on this date, so there is an extension which has been made. You are required to make the calculation of answer for this simple questions. The first is a cancellation rate. Second is amount payable on $1 lakh. That is the amount. Swap loss. Interest on the outlay funds. New contract rate. Total cost. Rates must be rounded off up to 4 decimal in multiple of 0.0025. Assume 365 days in a year. Like that, so the information is given to us. So let us have understanding that say how to calculate answer for this simple question. So now basically what will happen? Over here friends, the due date on which the contract was supposed to be executed was 4th of April. However, on that date, the customer did not turn up. So on 4th of April, what bank will do? Bank will enter into swap transaction. Because basically we understand that say original transaction was entered upon on 4th of January. So if at all we put everything on a timeline, it is like this. 4th of January was the date on which originally the transaction was entered upon. Two parties. One we understand is say the customer, and another is what we understand is the bank. From the customer point of view, the transaction was initially entered upon as sell of rupees and purchase of dollar on 4th of January, and this transaction was entered upon for 4th of April. Of course, the bank also entered into the opposite transaction with the customer and the same transaction in the interbank market. So the bank entered into two transactions, one with the customer, and with the customer it is sell of dollar and purchase of rupees. And from where can I get the dollar? For that, so the bank entered into the interbank market, and the interbank market is sell of dollar and purchase of rupees. That is what we understand. Okay. Now understand carefully what will happen. On 4th of April, customer did not turn up. So as far as the bank is concerned, the bank is required to enter into swap transaction. Entering into swap transaction means entering into two opposite transactions at one point of time. One is the spot transaction to cancel the original forward contract in which bank had entered upon. So one is the spot transaction. The spot transaction is to cancel the original transaction. Original transaction was sell dollar and purchase rupees. So now it is sell of rupees and purchase of dollar. Sell of rupees and purchase of dollar. That is the spot transaction which is required to be entered upon to cancel the original one in which the bank had entered into interbank market. Further, the bank is aware that the bank is responsible to the customer if the customer comes anytime within 3 days of this date, that is 4th of April. At that point of time, the bank may not be able to get the dollar from the international market. So the bank will enter into the nearest forward contract. Yes, the bank will enter into the nearest forward contract in order to purchase the dollar. So the forward contract will be entered upon for the nearest April month, and that will be, say, sell dollar and purchase rupees. Since two reverse transactions have been entered upon, we understand that it is a swap transaction. Dear students, my objective is, say, first of all, to give explanation of the question to you. Now, after 4th, 5th, 6th, and 7th, the bank is going to wait for the customer till 7th. Customer did not turn up. So what will happen on 7th? The bank will cancel the original forward contract of the customer on behalf of the customer. Yes. The original contract which was entered upon by the customer was sell rupees and purchase dollar. So now, as if the customer is cancelling the contract, sell dollar and purchase rupees, that is an auto cancellation that will be applicable on 7th of April spot rate. How to make the calculation, that all we are going to discuss. On 14th of April, when the customer will come, at that time, say he will be told, say, about the amount to be recovered from him, and further we understand that, say, the new contract rate will be given to the customer. This is the way, say, we will be having, say, the entire question to be solved. Before I read the questions, I would like to solve the question in a logical manner. So any of the question which may be asked you in examination, you will be able to solve it with the logical sequence. So I'll dictate note to you, and at the same time, so we are going to write the answer. So write an answer of the question. As per the information given, comma, on 4th of January 2021, comma, a forward contract entered upon as under. On 4th of January for 4th of April by customer with bank it is sell of rupees and purchase of dollar. Why? Because the fees is required to be paid over there. We can see that so the information is provided to us that the exchange rate is 73.8775. 73.8775 rupees per dollar. This is the way a kind of forward contract is entered upon. Next, on 4th of January for 4th of April by bank. One is with customer and another is in the interbank market. With customer, opposite of the original forward contract will be entered upon. Sell of dollar and purchase of rupees. 73.8775 rupees per dollar. Now bank with interbank. In that, it is sell of rupees and purchase of dollar. And for that, so the rate is provided to us like this, 73.7575. It is again rupees per dollar. These are the basic transactions which have been entered upon. Now comes 4th of April. On 4th of April, comma, customer did not turn up. Full stop. So, bank entered into foreign transactions. In that, the first one is a spot transaction. The spot transaction is for sell of dollar and purchase of rupees. Because what happens at say this interbank transaction, that is this interbank transaction which has already been entered upon, it is supposed to be executed by the bank. So whatever the dollar that I have purchased, that I will immediately sell in the market, and for that so the spot transaction will be sell of dollar and purchase of rupees. I am aware that I am responsible to give delivery of the dollar to the customer if at all the customer comes anytime within 3 days. So I have to enter into the nearest forward contract. Nearest forward contract for sell of rupees and purchase of dollar. Because anytime the customer can come for the delivery of the dollar, that is the reason I have to make an arrangement of the dollar from the international market. This is like technically we understand is a swap transaction. I'm writing over here the relevant rates so that we can have a clarity. So on 4th of April, the transaction is what we have written over here, sell of dollar and purchase of rupees. So we will get lower amount of the rupees. So 73.2775 is a relevant rate. Another is the nearest forward, sell of rupees and purchase of dollar. So over here, we have to take into account the nearest forward contract for the purpose of cancel. That is, say, for the purpose of entering into the contract to buy dollar. So the nearest forward on 4th of April is, we understand at say 73.4275, because the transaction is over here for sell of rupees and purchase of dollar. Dear students, over here it must be the spot April, that's we understand. So 73.4275. $73.4275. That is the rate which is applicable. Okay. So now the next date is 7th of April. On 7th of April, comma, on behalf of customer, comma, original forward contract is cancelled. Okay. So in that case, what will happen? Let us understand. We understand like this. Original forward contract was sell of rupees and purchase of dollar. On 7th of April, in the spot market, it is sell of dollar and purchase of rupees. That is what we understand. Okay. For original contract, the rate is 73.8775. And for the revised one, the spot exchange rate will be applicable on 7th of April. It is sell of dollar and purchase of rupees. So again, the lower rate will be applicable, 73.1575. 73.1575. It is rupees per dollar. These are the applicable rates. Okay. Now, lastly, say one more thing that I'm writing. On 14th of April, customer will enter into new forward contract for June 2021 for sell of rupees and purchase of dollar. That is on 14th of April. For the month of June, sell of rupees and purchase of dollar, 74.0525. This is the applicable exchange rate. This is what we understand. Here is the way we are required to do answer for this simple question. Yeah, so now let us have the execution of the answer. One by one, let us write the answer. Working note number 1. calculation of swap loss, of course to bank. Why? Because the bank has entered into the swap transaction. Dear students, over here is the swap transaction which was entered upon on 4th of April, and that is sell of rupees. This is the payment, and then purchase of the rupees, that is the receipt. Okay, so the answer is 73.4275. That is the rate at which you will buy the dollar, and then 73.2775. That is the rate at which we will sell dollar, and difference of that is a swap gain or swap loss. So over here 73.4275, that is the rate at which we buy dollar, and 73.2775 is the rate at which, say, you sell dollar, into 1 lakh. So 73.2775 minus 73.4275. So that is a loss of 15 paise. So the total amount of the swap loss is 15,000. Okay. Friends, just for your understanding purpose, had there been a gain, the gain will not be given to the customer and the loss will be recovered from the customer. Working note number 2. Calculation of amount on which interest to be collected from customer. So dear students, I am writing only the amount on which the interest is to be collected. It will be calculated using the difference between these two rates. You can see that, say, originally the transaction was entered upon to buy dollar at 73.7575, and then you sell dollar at the rate of 73.2775. So over here 73.2775 minus 73.7575 into 1 lakh. That comes to 48 paise. Because basically what happens at, say, this 48 paise must have been paid by them immediately. So 48 paise into 1 lakh, that comes to rupees 48,000. So this 48,000, so the interest will be calculated for 3 days time period. That is 3 days or the date on which the customer comes, whichever is, say, later. That is whichever is earlier. Working note number 3. In that calculation of rate at which contract of customer will be cancelled. It is 7th of April 2021. On that date, spot transaction, that is sell of dollar and purchase of rupees. Sorry, sell of dollar and purchase of rupees. This is the cancellation, because the earlier the contract was set to buy dollar, so now you are going to sell dollar. So on 7th of April, seller dollar and purchase rupees, you'll get less amount of rupees. 73.1575. 73.1575. Okay. Now, dear students, we understand, so this time the calculation is made from the customer point of view. So, whatever the amount of the rupees that the customer will buy, from that the margin will be deducted. Minus margin. So, 73.1575 minus 0.10 percentage. So, in that case, 73.0843. Okay. Now, there is one more condition that they have provided, or one more instruction you can say. That the rates are required to be rounded up, say to 0.0025. So, dear students, what you have to see? You have to see the last two digits. It is nearest to which, accordingly, you are required to do the round up. So, it is 73.0850. That is the way we are supposed to find the cancellation rate. Okay. Now, working note number 4 will be calculation of the profit or loss from cancellation of original forward contract by customer. In that, original contract was entered upon on 4th of January. It was entered upon for 4th of April. It is sell of rupees and purchase of dollar. Dear students, always we understand the original rate which is provided to us in the example is inclusive of the margin. So 73.8775. Now on 7th of April, the contract is entered upon for 7th of April once again. Sell of dollar and purchase of rupees. In that 73.0850. Okay. So what you have to pay is, and what you are going to receive, difference of both of them will be calculated, and that difference comes to 79.25 paise. The amount that you have to pay is exceeding the amount that you are going to receive by 79.25 paise. So 0.7925 into 1 lakh. That comes to 79250. That is the amount of the loss which the customer is required to pay. Now we are very near to the final answer. I am preparing one more working note. Working note for calculating interest to be recovered from customer. In that case, amount into rate of interest into n divided by the time period, that is 365 days. So the amount on which the interest is supposed to be calculated is 48,000. The time period is of course 3 days. And the rate of interest is provided, I think it is 12%. Yeah, 12%. And the time period is 3 days. So 48,000 into 12 percentage into 3 divided by 365. That comes to 47.34. Okay. Now almost coming to an end to the answer. Calculation of applicable exchange rate for new contract. So in that case, what will happen? On 14th of April for 14th of June, this is the rate applicable to buy dollar. So 74.0525 plus 0.10 percentage. That comes to 74.151265. So again we are required to round it, that is a round of the same 74.1275 rupees per dollar. This is the way the applicable rate will be calculated. Now one more working note. Calculation of amount to be recovered from customer. In that, first of all, the swap loss plus interest for the amount which was paid by the bank on 4th of April plus cancellation loss. Amount of swap loss is 15,000. The interest is 47.34. And the amount of the cancellation loss is 79250. This is the way we are required to compute the answer. 94,297 0.34. This is the amount to be recovered from the customer. Let us have the entire overview of the answer before we go for a one by one question which have been asked by the institute. So friends, initially the transaction was entered upon on 1st of April for, sorry, on 4th of January for 4th of April. The transaction was said to sell rupees and purchase dollar by the customer, and similarly, so the bank entered into the transaction. On 4th of April, customer did not come, so there was a swap transaction which was entered upon. Even on 7th of April, the customer did not come, so auto cancellation. Then on 14th, so the customer comes and we give a new contract. And accordingly, the answers are calculated by us. Then let us see one by one the answers that we are required to find. The first question is, what is the cancellation rate? Dear students, as far as the cancellation rate is concerned, for that, we understand that the working note number 3 answer is required to be given. This is the cancellation rate. That is 73.0850 because there is an auto cancellation. So 73.0850 rupees per dollar. The amount payable on $1 lakh, that's very simple. A kind of the loss which the customer has, that is an amount of rupees 79250. The next is a swap loss 15,000. Next is the interest on the outlay of the funds. On that 48,000 that we have found, 47.34. That is the amount of the interest. Of course, that is supposed to be collected from the customer. New contract rate which is given to the customer, that is 74.1275 rupees per dollar. And the total cost means the amount that will be recovered 94297.34. This is the way, say, we are required to give answer. Next question, question number 1B. Two companies, ABC Limited and XYZ Limited, approached the DEF Bank for FRA, forward rate agreement. Both the companies want to borrow a sum of rupees 100 crore after 2 years for 1 year. So after 2 years they want to borrow for 1 year. Bank has calculated, highlight the portion, yield curve of both the companies as follows. So for 1 year, for 2 years and for 3 years, yield curve is given for XYZ and for ABC. The question says that, say, identify at least one reason for the differences in the yield curve for the two companies. So the question says that, say, why there is a difference between these two companies' yield curve. We can very well see over here that XYZ is having the lower rate of interest, lower rate of interest, lower rate of interest. So the credit rating of XYZ must be better than ABC, and because of that, so the rate of interest offered to XYZ is lower. Answer of question number 1B. Rate of interest of XYZ is comparatively less because its credit rating would be high. Full stop. Next question. Calculate the rate of interest DEF Bank would quote under 2 into 3 FRA using company's yield information as quoted above. Means over here the question says that, so you are required to compute that what must be the rate of interest that would be quoted for 1 year borrowing after 2 years. 2 into 3 stands for after 2 years for 3 years. And for that, so we are required to use this rate of interest for making calculation. So we'll make the calculation like this. So the answer for the second part of the question is forward rate of interest. In that, calculation will be made in this way. For first of all, XYZ company, we'll make the calculation. It is 1 plus spot for the second year raised to 2 is equal to 1 plus spot for the third year raised to 3 into 1 plus forward for the third year raised to 1. That is, directly if you borrow for 2 years, then the rate of interest is 4.20%. So 1.042 raised to 2. You borrow directly for 3 years, it is 4.48%. 1.0448 raised to 3. So for 1 year, that is for the third year, the rate of interest will be found as balancing figure like this. So 1 plus F3 is equal to 1.0448 raised to 3 divided by 1.042 raised to 2. So now F3 will be calculated as answer of this equation minus 1. So 1.0448 raised to 3. So into 2, 3. That comes to 1.1405 divided by 1.042 raised to 2. So 1.0857. Whatever the answer, from that 1 will be deducted. So 1.1405 upon 1.0857. That comes to 1.05047. So I'm writing 5 minus 1. 0.0505. That is 5.05%. This is the applicable rate of interest for XYZ company. Similarly, we are required to work out the answer for ABC Limited. So for ABC, we will work out the answer in similar manner. 1 plus spot for the second year raised to 2 is equal to 1 plus spot for the third year raised to 3 into 1 plus F3. So 1 plus F3 is equal to 1 plus spot for the third year raised to 3 divided by 1 plus spot for the second year raised to 2. Now for ABC Limited, the 3-year spot rate is 5.78%. And for 2 years, it is 4.12%. This is raised to 3 and this is raised to 2. Whatever the answer that we have, from that 1 will be deducted. Accordingly, we are required to calculate the answer. So 1.057823, that comes to 1.1836 divided by 1.0, it is 548. So 1.0548 to, that is 1.1126. Whatever the answer that we have, from that 1 is deducted. 1.1836, 1.1126, so 6.38%. This is the way we are required to make the computation of the forward rate for the third year for each of the company. It is 5.05% for XYZ. So for XYZ, it is 5.05%, and for ABC, it is 6.38%. Third question. Suppose the bank offers interest rate guarantee. This is a new point that we have in this question. For a premium of 0.1% of the amount of the loan, calculate interest payable by XYZ Limited if the interest rate in the 2 years turns out to be 4.5% and 5.5%. That is a question. So let us see how to do answer for the third question. calculation of total cost of borrowing for each of the situation. That is what we are required to answer. Now friends, we have been given with the rate of interest information as 4.5 percentage and 5.5 percentage. See, the amount that we are supposed to borrow is provided to us in the example as an amount of 100 crore. So we will be having interest payment, then we will be having the premium payment, and based on that, the total cost will be calculated. And we can have one more working as the effective cost. We understand that over here you already have entered into a forward contract in which you have to borrow at the rate of 5.05 percentage. Okay. Now we understand that if at all the forward contract is entered upon, so that is the rate at which you are going to borrow, that is 5.05 percentage. However, you are making payment of the premium. So what will happen? You have, that is over here, 0.1% is paid by you. So in order to make an assurance that if at all you want to lapse the right, then in that case you can lapse the right. That is what we understand. So the amount that you have to pay in form of premium is 10 lakhs in the first case and 10 lakhs in the second case. That is required to be paid unconditionally. So when the rate of interest is 4.5 percentage, then in that case you will not exercise your right to, or you will not have the borrowing at 5.05 percentage. Instead of that, you will borrow at 4.5 percentage. So over here it is 100 crore into 4.5 percentage. That comes to 4.5 crore. That comes to in total 450 lakhs. So the total cost is 460 lakhs. The cost of 460 lakhs for the purpose of using an amount of 100 crore into 100 for the purpose of getting answer in percentage term, and the effective cost comes to be 4.6 percentage. If at all the rate of interest is 5.5, then in that case what happens at, now you will borrow at the forward rate of interest, that is 5.05 percentage. So 100 crore into 5.05 percentage. So you have a kind of right, but you are not under an obligation to borrow at 5.05 percentage. Why? Because you have entered into the interest rate guarantee agreement. So 100 crore into 5.5 percentage, 5.05 percentage. That comes to 505 lakhs. The total is 515 lakhs. So the cost of 515 lakhs for the purpose of using an amount of 100 crore into 100 for getting answer in percentage term, and the effective cost comes to 5.15 percentage. This is what we understand. So we can have this kind of effective cost. Okay, I'm just dictating a small note to you with respect to the interest rate guarantee. Read on a note. By entering into interest rate guarantee, company reserves the right to borrow at 5.05 percentage forward rate of interest, comma, instead of borrowing at rate of interest prevailing in the market. Full stop. With paragraph right down. Importantly, if the rate of interest is more than or equal to 5.05 percentage, comma, in that case, total cost will be rupees 515 lakhs. However, if rate of interest is lower than 5.05 percentage, comma, then there will be a reduction in cost of borrowing. Full stop. Question number 1C. Whether financial risk can be evaluated from the different point of views? If yes, please explain them briefly. This is a question basically from the chapter Risk Management, that is chapter number 2. In that we understand that there are three different methods, that is three different point of view that we have. One is from investor point of view, second is from company point of view, and third is from the government point of view. That is the way we have the three different point of view for the purpose of measurement of the risk, that is measurement of the financial risk. From the stakeholders point of view, the major stakeholder of a business are equity shareholders, and they view financial gearing. Gearing stands for introduction of the committed sources of the finance in capital structure. That is the ratio of the debt in capital structure of the company as a risk, since in the event of the winding up of the company, they will be least prioritized. Even for a lender, existing gearing is also risk, since the company having high gearing faces more risk in the default of the payment of the interest and the principal repayment. So here the term stakeholder is required to be understood broadly, not only the equity shareholders, however it includes even the debenture holders. The second is from the company point of view. We understand that from company point of view there is a risk of the liquidation. If at all the high debt financing is there and the company is not able to make payment of any financial charges or redemption of the debentures on time. From company point of view, if the company borrows excessively or lend into someone who defaults, then it can be forced into the liquidation. From the government point of view, Again, it is considered to be a great risk from the government point of view. Whenever there is any, like the financial intermediary or anyone who defaults, then in that case there is a environment of the distrust in the market. Of course, it amounts to losing of the employment. It amounts to like the uh, issue for the economy to run. From the government point of view, the financial risk can be viewed as a failure of any bank, like Lehman Brothers, downgrading of any financial institution, leading to spread of the distress among the society at a large. Even this risk also includes the willful defaulters, and unfortunately, so this is creating a huge impact in the market. This can also be extended to the sovereign debt crisis. Question number 2A. PQ Limited is planning to acquire and absorb the running business of LM Limited. So PQ is acquiring company and LM is a target company. The valuation is to be based on the recommendation of the merchant banker and the consideration to be discharged in form of equity shares to be issued by acquiring company PQ Limited. Full stop. As on 31st of March 2021, the paid up capital of the PQ Limited consists of 80 lakh shares of rupees 10 each. The highest and the lowest market quotation during the last 6 months were 855 and 645. This is important. For the purpose of exchange, price per share is to be recognized as the average of the highest and the lowest market quotation during last 6 months ended on 31st of March 2021. So basically what happens, actually we understand that whenever the consideration is to be discharged by issue of the equity shares, then in that case the target company has a point that the market price of the acquiring company is overpriced. So we should keep the price which is lower. And the acquiring company is always having a contention that the price is like low and we want to increase the price for the purpose of discharging the consideration. So over here a very good solution is given that instead of going with all this negotiation, let us see the last 6 months market price quotation. The highest price so far 850, that is 55 in the last 6 months, and the lowest one is 645. So average of both of them is 750. So for one equity share the price will be considered 750 for the purpose of acquisition. LM Limited's balance sheet as on 31st of March 2021 is summarized below. Share capital of rupees 10 fully paid up 300 lakhs, 15 lakh equity shares of 10, and highlight the portion only 5 rupees is paid up, that is 75 lakhs. Debt financing is 150, fixed asset is 225 and 300. An independent firm of the merchant banker engaged for negotiation have produced the following estimate of the cash flows of the business of LM Limited. So starting from 31st of March 2022, 23, 24, 25, 26. So we can say that first year, second year, third year, fourth year and fifth year. For 5 years, so the cash flows have been provided to us. It has been given to us on yearly basis, and this is important. Terminal value estimate means 6th year onwards for perpetuity, whatever cash flow that the business is going to generate, all of them have been discounted to 5th year end. So in technical language we can say it is P5. It is the recommendation of the merchant banker. Now this is important, friends. See over here, language of the question speaks like this. The valuation is to be based on the recommendation of the merchant banker. Now what merchant banker has recommended is provided over here. It is a recommendation of the merchant banker that the business of LM Limited may be valued on the basis of average of 1. Aggregate discounted cash flows at the rate of 8%, that is future cash flows will be discounted at 8%, and net asset value So total assets minus total liabilities is net assets. Okay, so you are required to compute the total value of the business of LM Limited for the purpose of acquisition, of course. So it is present value of the cash inflow, net asset, will do average of both of them. Number of shares to be issued by PQ Limited. Suppose, for example, the answer of the first part of the question comes to 7,50,000. 750 is the average price, so 7,50,000 divided by 750, 1,000 equity shares will be issued. The question says that, say, what is the basis of allocation of the shares? We can see, friends, that over here, importantly, it has been given that the paid up value of the shares are different. So, we are required to compute the paid up value proportion. It is 300:75, that comes to 4:1. So, in the proportion of 4:1, we will issue the shares. How many? 1,000, just assume figure. So, whatever the number of shares that we compute in the second part of the question will be distributed in the ratio of 4:1. Using the present value factor at the rate of 8%. So here, so they have provided the discounting factors, and it is very much necessary that, say, we are using these factors only for the purpose of discounting the cash flows. Make calculation up to 3 decimal points, and this is also very important. Whatever this kind of instructions which have been provided to us is required to be followed mandatorily, friends. If at all you do not follow them, then in that case there are absolute chances, means surely your marks will be deducted in that case. So the sequence in which we are going to work out the answer will be like this. In the first answer, we'll make the computation of the present value of the cash inflow. That's very simple. As a part of the first answer only, we'll compute the net asset. In that we understand the total asset is an amount of 525 lakhs and the total liability is 150. Difference of both of them is the net asset. Then we'll compute average of this two. And that is what we understand is the fair value for the purpose of acquisition. In the second part of the question, we'll compute first of all a small working note for 750 and answer of the first part of the question upon 750 will give the answer that, say, how many shares are to be issued. Whatever the shares that we compute in the second part, that will be, say, distributed in the ratio of 4:1, and say those number of shares will be issued to the shareholders of both the companies. That is the way we are required to make the calculation of answer. So first of all, working note number 1, in which we'll compute the present value of the future cash flow. So write down answer of the question number 2A. In the write down, calculation of present value of future cash flows. Column number 1 is date. Column number 2 is year for our understanding. Cash flows, present value factor at the rate of 8%, and present value cash flow. That is the way first of all we'll do the valuation. So at the end of year 1, 2, 3, 4 and 5. Cash flows have been provided to us. End of year 1 cash inflow is 157.50 lakhs. End of year 2 it is 180 lakhs. End of year 3 it is 187.5 lakhs. End of year 4 it is 180 lakhs. End of year 5 it is 150 plus 300 lakhs. That comes to 450 lakhs. These cash flows will be discounted at the rate of 8%. The first year discounting factor is 0.926. Second year discounting factor is 857. Third year discounting factor is 794. Fourth year factor is 735. And last year factor is 0.681. Now, importantly, it will be discounted and will write the answer in 3 decimal points. So just be careful for that. So 157.5 into 0.926, that is 145.845. Next is 180 into 0.857, so 154.26. 187.5 into 0.794, so 148.875. 180 into 0.735, so 132.30. 450 into 0.681, so 306.45. This is the way the present value will be calculated. The summation of that is 887.730. This is the valuation based on the present value of the cash flow. Now, after this, we are required to do the valuation for the, that is based on net asset method. So, working note number 2, calculation of valuation based on net asset method. In that, total assets minus total liabilities. Total assets is 525 and total liabilities 150. $525 minus 150, that is 375 lakhs. This is the way the net asset can be calculated. Working note number 3, calculation of value of target company for the purpose of acquisition. In that, present value of the cash inflow plus net asset divided by 2. The present value of the cash inflow is 887.73. Plus 375 divided by 2. So it is 631.365 lakhs. This is the value for the purpose of acquisition. Now, second part of the question is, how many shares are to be issued by PQ Limited? So, answer for the second part of the question. Calculation of number of shares to be issued. Share and amount. If at all you issue one equity share, then in that case, price for that security for the purpose of merger will be 855 and 645, average of those two values. 855 plus 645 into 1 by 2, that comes to 750. So 631.365 lakhs to discharge the consideration equal to this. This is the number of shares to be issued. 631.365 lakhs into what, that does not make a sense, divided by 750. This is the number of shares which are required to be issued. That comes to 84,182. That is the way we are required to give answer for the second part of the question. Last question. What is the basis of the allocation of the shares among the shareholders of LM Limited? That is a question. So 30 lakhs and 15 lakhs. So answer of the third question. Basis of allocation of the shares. It is simple, the paid up value proportion. So the paid up value is 300 lakhs and 75 lakhs. So the total is 375 lakhs. So it is 0.80. And this is 0.20. So this is the proportion. Number of equity shares are 84182. So what will happen? 84182 into 0.8. That comes to 67,345.6. So 67,346 shares, and the remaining will be 16,836. That will be issued to the other shareholders. So this is the number of shares issued. This is what we understand. So finally we can say that the working is supposed to be made in this way. First of all, a very simple calculation, the present value of the future cash flow, that is value of the company. Then net asset, total assets minus total liabilities. An average of both of them is the valuation of the target company for the purpose of acquisition. Then number of shares to be issued, in that we'll take the average of the highest and the lowest price to compute the number of shares to be issued. And then the basis of the allocation of the shares. It is 4:1. That is the proportion in which the shares will be issued. Let us see next question. Question number 2b. CMT pension fund has a portfolio of the shares of diversified companies valued an amount of rupees 800 crore. Enters into swap. Swap means interchange. Arrangement with Boom Bank on the terms that it will get 1.15% quarterly on notional principal of rupees 800 crore in exchange of return on portfolio, which is exactly tracking Sensex, which is presently 43,200. You are required to determine, highlight the portion, net payment to be received or paid if the Sensex turns out to be 43720, 43560, 44,116, 43,920 at the end of the each quarter. Make calculation in crores of rupees and round off calculation up to 4 decimal points. That is the way we are required to give answer. So friends, over here we are required to make the computation of the return of the Sensex for each of the quarter. We understand that the Sensex value has gone up from 43,200 to 43720. So there is a positive return. It is going down, so it is negative return. Going up, so positive. Going down, it is negative. So we are required to make the computation of the return. We understand that say we are required to compute the difference between say the fixed amount and this return that we compute on the notional amount, and difference of that is required to be paid, or it is required to be received on the quarterly basis. So let us prepare first of all the working note for calculation of the quarterly return. So let us answer the question. Working note number 1, calculation of return for each quarter. First, second, third and fourth. For these 4 quarters we are required to find the return. We understand that it is 43720 minus 43,200 divided by 43,200. So as far as the return for the quarter number 1 is concerned, it is calculated as 43720 minus 43,200 divided by 43,200 into 100 for getting answer in percentage term. And the answer comes to 1.2037%. This is the way the return of the first quarter can be found. Let us see that say what will happen in the second quarter. 43560 so 43560 minus 43720 divided by 43720 into 100 for getting answer in percentage term. (43560) minus 43720, that is 160 negative, divided by 43720 into 100, that comes to negative 3.3660%. That is the negative return for the second quarter. For the next one, it is 44160 minus, we understand that it is 43560 so divided by 43560 into 100 for getting answer in percentage term. So 1.3774%. That is a positive return. Next quarter is 43920 minus 44160. 43920 minus 11460 divided by 11460 into 100, that is negative 0.5435%. That is the way quarterly return is required to be calculated. So now after making the calculation of this
rate of return on Sensex. Let us now understand and say how the cash flows will be exchanged. CTM pension fund has a portfolio of the shares of the diversified companies valued an amount of rupees 800 crore, enters into the swap arrangement with Boom Bank on the terms that say it will get, so it is going to receive 1.15% quarterly on the notional principal of 800 crore. So again you can use a calculator. 800 crore into 1.15%, that comes to 9.2 crore. That is the amount that say you are going to receive every time. This is what's the amount that say you are going to receive, which is exactly tracking. Will get a notional on the principal of what, that is 800 crore, in exchange of the return of the portfolio, which is exactly tracking, so the Sensex, which is presently 43,200. So we understand that it is going to receive 9.2 and it is going to make the payment, say the calculation that say we have made. So over here, every time you will receive an amount of 9.2 crore. In every time you have to pay whenever it is a positive return, and if it is negative return, then further you will receive. That is the way you will be having the settlement to be made. So let us make the computation that say what is the amount that will be received or paid by CMT pension fund, say for each quarter. So write an answer. Calculation of net amount receivable or payable at the end of every quarter. That is what say now we are going to understand. First quarter, second quarter, third quarter and fourth quarter. Net amount. See what happens, let's say you are required to pay 1.2037 and what you are going to receive is 1.15. So 1.15 minus 1.2037. So 1.15 minus 1.2037. That comes to negative 0.0537%. So 800 crore into 0.0537%. That comes to 0.4296 crore. That is what you are supposed to pay. We understand that what you are going to receive is 1.15 and what you are supposed to pay is 1.2037. So difference of that is negative, so you have to pay. Next, it is negative 0.366. So importantly friends, over here what will happen, it is 800 crore into 1.15 minus negative 0.366%. So 1.15 plus 0.366. So it is 1.511. That is 1.516. So it is 800 crore into 1.516%. This is what you are going to receive. That is 12.18 crore. 12.128 crore. This is what you are going to receive. In the third quarter, again the return on the Sensex is greater than 1.15, so you are required to pay. So we understand that over here it is 800 crore into 1.15 minus 1.3774. So it is negative 0.2274 crore. %. So 800 into 0.2274%. That comes to 1.8192 crore. That is what you are required to pay. $1.8192 crore. That is what you have to pay. In the last case, what will happen? Let us see. The return is negative 0.5435%. So what will happen? It is 800 crore into 1.15 minus negative 0.5435%. So negative will become positive. So it will be added. So 1.6935. So 800 crore into 1.6935 percentage. So 13.548 crore. This is what you are going to receive. This is the net amount that is receivable or payable at the end of each quarter. So friends, over here we have strictly followed the instruction that they have provided to make the calculation of the rupees in crores, and calculations are to be made in 4 decimal points. C question. MVA, market value added, is an attempt to resolve some of the issues involved in economic value added. Explain this statement. So this is what's a theory question which we are required to answer. The answer of the question is very simple. To some extent, it can be said that market value added is an attempt to resolve some of the issues involved in the economic value added. For example, ignoring value drivers, book value, etc. Though market value added itself does not give any basis of the share valuation, but an alternative way to gauge performance efficiencies of an enterprise. Elevate, that is, although from the market capitalization point of view, the logic behind market will discount the efforts taken by the management fairly. Hence, the market value added can be perceived as true value added by the market. In contrast, economic value added is derived value added, that is for more discerning investor. Since the market value added represents the market view regarding the company's future value generation, companies with the higher market value will naturally become like more adorable of the share market and would eventually become the pricey from the pure pricing point of view. In such cases, the economic value added may sometimes have a slightly negative correction as compared to the market value added. But this will be short-term phenomenon, as eventually the gap closed by the investors themselves. A stock going ex-dividend will exhibit such prosperities. Thus, we can conclude that main objective of the EVA is to show managerial efficiencies in generating returns over and above the hurdle rate of the invested capital. That is what we understand. Next question. Question number 3A. Interlimited, promoted by transnational company, is listed on stock exchange holding 80% The value of the floating stock is rupees 45 crore. Market price per share is 115. The capitalization rate, the discounting rate is 20%. The promoter's holding is to be restricted to 75% as per the norms of the listing requirement. The board of directors have decided to fall in line to restrict the promoter's holding from 80% to 75% by issuing bonus shares to minority shareholders while maintaining, highlight the portion, same price earning ratio. You are required to calculate the very first question, what is the bonus ratio? Means what is the ratio in which the bonus shares will be issued to the minority shareholders. So friends, over here we understand that the promoters will issue bonus shares to the minority shareholders, and such number of shares will be issued to the minority shareholders so that the promoter's holding will reduce, say, from 80% to 75%. So friends, over here we understand, just we are having some informal discussion before we proceed. The value of the floating stock is an amount of 45 crore which is provided to us. And we have been provided with the market price per share. So we, based on that, say we can compute the number of shares. So we can say that, say over here 45 crore divided by 150, that comes to an amount of 30 lakhs. Yes, so 30 lakh is the number of shares held by the outsiders, because we have been, that is provided with the information floating stock, and we have been provided with the information that the promoters holding is 80%, so outsiders holding is 20%, and that outsiders holding is 30 lakhs. So 30 lakhs divided by 0.2 that comes to 150 lakhs. 80% of 150 lakhs comes to 120 lakhs. This is the way we can have split between the promoters holding and outsiders holding. Now we understand that, say, this 120 lakhs should become 75%. Why? Because the promoters holding should not exceed 75%. So 120 divided by 0.75, that comes to 160 lakhs. 150 to 160, so we understand that, say 10 lakhs should be given in form of the bonus shares, and that is 25%. So 10 lakhs again 30 lakhs, it comes to 1 for every 3 shares. That is the way we are required to make the computation of the bonus ratio. So let us make this much calculation and then we will proceed further. So answer for question number 3A. In that, write down working note number 1, calculation of number of equity shares held by outsiders. It will be found like this: free float market capitalization divided by market price of the share. ₹45 crore, that comes to 4,500 lakhs, divided by market price of the share, it is 150. So 4,500 divided by 150, that comes to 30 lakhs. Now the that is holding by the promoter is 80%. So holding by outsider is 20%. So working note number 2, calculation of total number of shares and shares held by promoters. So we understand in that promoters outsiders and total 80% held by promoter, 20% held by outsider, and the total is 1. This is 30 lakhs. So the total number of shares would be 30 lakhs divided by 0.2. That comes to 150 lakhs. 150 lakhs into 0.8. That comes to 120 lakhs. That is the way we are required to make the computation of the split of the total number of shares into promoters and outsiders. So now taking this 120 lakhs and we have to keep it 75%. We'll make the computation of the total number of shares after bonus issue. Then we'll compute the bonus shares and then we'll compute the bonus ratio. So working note number 3, calculation of total number of shares after bonus issue. In that, shares held by promoter divided by percentage of holding by promoters. Shares held by promoter would be again 120 lakhs, but now it would be 75% of the total number of shares. So 120 divided by 0.75, that comes to 160 lakh shares. Now this will give us the bonus shares and bonus ratio. It is total number of shares after bonus issue minus total number of shares before bonus issue. So in that it is 160 lakhs minus 150 lakhs. It is 10 lakhs. And based on that, so we'll compute the bonus ratio. Bonus ratio will be found as bonus shares divided by shares held by outsiders. Before bonus issue. So in that case it is 10 lakhs divided by number of shares held by outsiders before bonus issue are 30 lakhs. So the answer is 1:3. So 1 share for every 3 shares held. This is the way we are required to compute the answer. The question says that what is the market price of the share after the bonus shares? That is a question. So second part of the question, in which calculation of market price of share after bonus issue. Let us see how to make the computation of answer. It is market capitalization divided by number of equity shares. Okay, what is the market capitalization? Dear students, we understand that this 150 rupees per share into number of shares are 150 lakhs. That is 150 rupees per share into 150 lakhs divided by the number of shares after bonus issue is 160 lakhs. Because the overall market capitalization is not going to change, it is going to remain same. So 150 into 150, that comes to 22,500 lakhs. Divided by 160 lakhs, that comes to 140.625. This is the way the market price per share after the bonus issue can be calculated. Dear students, over here the question is also providing the information the price earning ratio is going to remain same. So using the price earning ratio also you can calculate the answer, and even with that you will be able to get the same answer. So if at all we make the computation using the price earning ratio, how to do answer, I am explaining that to you. For that, this capitalization rate information is going to be used. So we can have an alternative presentation of the answer like this. PE ratio is equal to 1 upon cost of capital. Discounting rate is 20%. So 1 divided by 0.20. That comes to 5 times. This is the way the price earning ratio can be calculated. Now we understand that before bonus issue and after bonus issue. It is earning divided by number of shares, EPS, price earning ratio, market price per share, and market capitalization. This is the way we can prepare a small table for doing answer. We understand that the before bonus issue, the market price per share is an amount of 150 that is provided to us in the example. The price earning ratio that we have recently calculated, it is 5 times. So based on that we can compute the earning per share, and earning per share is 30. How this 30 rupees is found? It is 150 divided by 5. That is the way we can make the backward working. Before bonus issue, the number of equity shares of the company is 150 lakhs. So the total earning of the company must be an amount of 150 into 30, that is rupees 4,500 lakhs. This is what we understand is the before bonus issue. Now after bonus issue, what will happen, dear students? As far as the total earning is concerned, it is not going to change. Why? Because it is only the capitalization of the reserves. Number of equity shares will increase to 160 lakhs. Why? Because 10 lakhs are issued in form of bonus shares. So 4,500 divided by 160, that comes to 28.125 into 5 times, that comes to 140.625. Now as far as the overall market capitalization is concerned, we understand at say 150 rupees price per share into 150 lakhs, that comes to 22,500 lakhs. And after bonus issue, it is 140.625 into 160 lakhs. That is again, of course, it is going to be same 22,500 lakhs. That is the reason say we can do answer by either of the method. So either of the way you can make the calculation, and fundamentally always remember that the value of the company will increase with the good performance of the company by accepting certain projects which have positive NPV, by taking a decision about the replacement which has positive NPV. With that, so the value of the firm will increase. This kind of restructuring is not going to have say any increase in the market value of the firm. Free float market capitalization after the bonus shares. So answer of the third question. Free float market capitalization after bonus issue. It can be calculated by one of the two methods. Either it can be computed as number of shares held by outsiders multiplied with market price of the share. So it is 40 lakhs into 140.625. That is the way it can be computed. 40 into 140.625, that is 5625 lakhs. This is the way you can compute, or otherwise you can make the calculation like this also. Total market capitalization into free float holding. That is in percentage term. Overall market capitalization is 22,500 lakhs into, we can see that so the promoters holding is restricted to 75%. Means outsiders holding is now 25%. So 22,500 into 25%, that comes to 5625 lakhs. This is the way we can make the computation of the free float market capitalization after the bonus issue. So let us have a small summary of the entire answer. First of all, working note number 1, calculation of the number of equity shares of the company right now. For that, so the number of shares held by the outsider is 30 lakhs, that is free float market capitalization divided by market price per share. Then total number of shares held by the promoters, this 30 lakhs comes to 20%, so the overall it would be 150 lakhs. Then we understand that say the number of shares held by the promoter should be 75% of the total holding. So the total number of shares should increase to 160 lakhs. So from 150 to 160, it should increase by 10 lakhs. So those 10 lakh number of shares are issued to minority shareholders, that is 30 lakhs. So the bonus ratio is 1 for every 3 shares held. Market price of the share after bonus issue. For that, say I have explained you by 2 methods. One is most logical method, the overall market value of the firm divided by the number of shares, that comes to 160 lakhs. So the current market value in total divided by revised number of shares after issue of the bonus shares, and in that case it comes to 140.625. This answer can be calculated alternatively by using a different formula, wherein we understand that say first of all we compute the cost of equity, then you prepare a simple table, earning of the company divided by number of shares, that gives EPS, into price earning ratio will give MPS. This time MPS is given, price earning ratio we have computed, so we have computed EPS as a backward working. Number of shares right now 150 lakhs, so the total earning is 4,500 lakhs. After bonus issue, what will happen? This 4,500 lakhs in total will remain same, divided by number of shares 160 lakhs. Why? Because 10 lakhs is the bonus shares. That will give us EPS. So the earning divided by number of shares will give, so the earning per share 28.125. Because we understand that so the number of shares have gone up, price earning ratio is remaining same, so the MPS can be calculated and the total market capitalization is bound to be same. Free float market capitalization after the bonus issue, that can be calculated by one of the 2 methods. We understand that so the shares held by the outsider into market price of the share. Shares held by the outsiders are 40 lakhs, 30 plus 10 into MPS, or otherwise total market capitalization into 25%. That is the way we can make the computation of the free float market capitalization. Next question, question number 3 being, an investor is considering purchasing of the equity shares of LX Limited, whose current market price is 150. Proposed dividend is ₹6 for the next year. LX expects to grow at the rate of 18% per annum for next 4 years. The growth rate will decline linearly to 14% per annum after first 4 years. Thereafter will stabilize at 14% indefinitely. Discounting rate is 18%. You are required to determine the intrinsic value of one share, whether it is worth to purchase the equity share at this price. Year 1 to year 8 discounting factors information have been given to us. So it's a very simple question about the dividend discount model approach. So friends, over here we understand that so the question is providing the information that the growth rate is 18% for the next 4 years. So we have been provided first year, second year, third year, fourth year, the growth rate is 18%, and then it will decline linearly to 14% after first 4 years. It means that say it will grow at 17, 16, 15, that is in the 5th year, 6th year and 7th year. Once 7 years is completed, then the growth rate is going to be 14% for perpetuity. Thereafter, it will stabilize at the rate of 14% per annum for indefinite time period. The discounting rate is provided as 18% per annum. You are required to determine the intrinsic value of one share, that is a question. So we can prepare the cash flow series for 7 years and so we can make the computation of the P0. In order to prepare the cash flow series for 7 years, we are required to compute the dividend per share from year 1 to year 7. That is the way we are required to make the computation of the answer. So write down answer of the question. Answer for question number 3B. In that, write down in this question we have to use DDM, dividend discount model approach, comma, to compute P0. Growth rate will stabilize at the rate of 14% from 8th year onwards. Full stop. So we will prepare a cash flow series for 7 years, comma, to compute P0. This is the way we are required to calculate the answer. So write down answer. Working note number 1. Calculation of dividend per share. In bracket I am writing year 1 to year 8. Dear students, 8th year dividend is calculated with the reason that we can compute P7. Okay. Year 1. Language of the question is absolutely clear. There is no ambiguity. The company is proposing dividend of ₹6 for the next year. So dividend at the end of year 1 is going to be ₹6. Second year it is going to be 6 into 1.18. That is 7.08. Next it is 7.08 into 1.18. 8.3544, so I am writing 8.35. Next 8.35 into 1.18. 9.853, so I am taking 9 rupee 85 paise. After 4 years, say now the growth rate is going to be 17%. Why? Because linear it will decline and it will stabilize, say, to 14%. So 9 rupee 85 paise into 1.17 raised to 1. So 11 rupees 52 paise. then 11.52 into 1.16 raised to 1. 13.3632, so let us take 13.36. Next, 13.36 into 1.15 raised to 1 once again. So 13.36 into 1.15, so 15.364. Now there is a stability of the growth rate. So 15.36 into 1.14 raised to 1. So 17.51. This is the way dividend per share for 8 years can be calculated. Now working note number 2 will be P7. It will be calculated as D8 upon KE minus C. 8th year dividend is 17.51. Divided by the discounting rate, that is 18%. Minus growth rate is 14%. That is the way we will make the computation of the P7. So 17.51 divided by 4%. So 437.75. Now this is what we understand is the price of the security at the end of the 7th year. Now 1 to 7th year, like the dividend amount and P7, all of them will be discounted to year 0 to compute P0. That is the way the P0 can be calculated. So this is of year 7 end. Now the final answer of P0. In that, column number 1 is year, column number 2 is cash flow, column number 3 is discounting at the rate of 18%, and the last column is present value. Based on that, so we will make the calculation of the price of the security in year 0. So let us see that how to make this calculation. First year, second year, third year, fourth year, fifth year, sixth year and 7th year. We'll keep all this dividend income, and 7th year price will be cash inflow further at the end of the 7th year, and it will be discounted with the discounting rates which have been provided to us. Remember that whenever they provide us the discounting rates, it is mandatory for us to use those discounting rates for the purpose of making calculation of P0, and so that is for the intrinsic value of the security, or the maximum price that investor is ready to pay to buy the security. So now let us have the discounting final 6 into 0.847, that is 5.08, 7.08 into 0.718, 5.08 once again, 8 rupee 35 paise into 0.609, that comes to again 5.08. The reason for that is very simple, because the growth rate is 18% and the discounting rate is also 18%. 9 rupee 85 paise into 0.516, that is again 5 rupee 8 paise. 11.52 into 0.437, so now it is 5.03. 13.36 into 0.37, 4 rupee 94 paise. Then 15.36 plus 437.75, that is 453.11, into 0.314, that is 142.28. Based on this, we can compute the P0. So it is 1, 2, 3, 4. 5.08 into 4, that is 20.32, plus 5.03 plus 4.94 plus 142.28, and the total comes to 172.57. That is the way we can make the computation of the market price of the equity share, that is the equilibrium price of the security or intrinsic value of the security is required to be found. The second part of the question, to solve it, we have to read this information carefully. Market price of the share is given 150. Is it worth purchasing the share? That is a question. So what we can do, we can make the computation of the second part of the question like this. We can make computation of the NPV, that is present value of the cash inflow minus investment. So 172.57 minus 150, that comes to rupees 22.57. So we understand that say as NPV is positive, it is worth purchasing the security. So the decision is like this. As NPV is positive, comma, security should be purchased. This is the way we are required to draw the conclusion. So revising the answer, first of all, we are required to make the computation of the dividend per share for 8 years, because we will prepare the cash flow series for 7 years. Because after 7 years, the growth rate is becoming constant for perpetuity. Then P7 calculation. Then based on that, say we make the computation of the P0. This is the way we are required to compute answer of the first question. Lastly, NPV calculation. NPV is positive, so the security should be purchased.